Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the boys from Convoy, Dustin and Jonathan. How you guys doing?
Good, good. Thank you.
Awesome, awesome. Welcome back, Dustin. We missed you for a couple weeks.
Thank you.
Your boy Jonathan held you down, though. He was doing great work.
Always does.
There you go. How you doing, Jonathan?
Alive, alive, alive. It's so hot in San Diego. It's like humid. I'm like,
Mike.
it's kind of. I miss LA.
There you go. So that's hilarious. So let's talk about the Fed, right? We have a Fed meeting decision November 2nd, sorry, December 14th. We talked offline about could rates get to 10, and you're like, dude, we're almost there in the non-QM space. So yeah, let's talk about the Fed. So where do you think where do we go by the end of the year? There's two meetings. We'll go to Dustin first. What kind of hike do you think you get November and then December?
I'm pretty sold right now that it's 75 in November and December. And I think we should go one more time in February, maybe quarter or a half. And then we'll be at, what is that? 5 to 5 1/4. And then we can pause for a little bit and maybe have a pivot sometime middle 2023, maybe. But I don't think we've said this multiple times when we've been on your show. The best solution, in my opinion, right now is just ripping the Band-Aid off as quick as possible.
Let's get done. Rip it off.
This is a slow bleed that I don't think anybody's having too much fun with.
It's not enjoyable.
Yeah.
It's not enjoyable. All right, Jonathan, you in the same camp, or you have a different opinion?
No, I think we're on the same camp. Just watching the trajectory from the last, like we at the beginning of the year, we thought there was no way that rates would be at 8% right now or 9%, right? Dustin and I had a conversation about it yesterday. We were like, when we were doing our like projections for like future and how we were gonna do, we were like, dude, when we started the year, we thought it would cap out at like 5-6%. Now we're already talking about 8-9%. Private money's at 11-12%. Like we're talking about like, these double-digit rates now already, and we're like, dude, that's crazy. So I think that kind of trajectory shows that, yeah, it's definitely possible. But like Dustin said, the slow burn hurts us a lot because Wall Street keeps changing what they want. Exactly. And unfortunately, because Wall Street keeps changing what they want, that's why our rates keep going up, right? Yeah. For everyone that's watching, Wall Street controls the rates. The money controls the rates, and that's what's causing it. Yeah.
I totally agree. Yeah, I think we're going to get 75. I did say this morning on my daily financial news that the good news is we're almost done, right? I do think, like you, Dustin, I think the next 3 meetings get a rate increase. I do think we get to a terminal rate of 5 1/4. But then we calm down. Then I actually hope we stay calm all year. I hope they do that one bump in February, whatever that first meeting is, and they just chill out for the rest of the year, because then what it will allow is Wall Street to calm the freak down, right? They have like a 350 basis point move, right? Or gap or spread or whatever the right lingo is. It's unheard of, right, Dustin?
They're making their spread from what they're able to, park their money overnight, we'll say, and what they're offering to us is larger than, it was.
Ever.
Yeah. So they're reeling in dough right now, which is obviously, from the smaller people in this world or economy, it's frustrating that they're actually doing better now, but that's the pure reality of it.
Yeah. And the beauty of this is, again, back to the rip, like if the Fed came out and took us up 200 basis points in a surprise Saturday meeting, that would suck, but it would suck for a minute.
It'd be better.
We would all it would be a bad Monday and a bad Tuesday. We'd all reset, and then the life would move on.
Yep.
Right. Because really what we need is we're getting kicked in the nuts twice, right? The Fed's doing their thing. Then Wall Street, who's got all the money, is just fattening their spread. One of the reasons they're fattening their spread makes logical sense. I don't know if I buy it, but it makes logical sense. Basically, they're widening the spread because they see refi risk, right? Because again, right, you get into a 9% loan, but if you're refied out 9 months, you haven't made any money. You probably lost money, right? So that's one of the reasons. Again, that's why I think we've got to get to this terminal rate, call it 5, chill out all year. And then what happens? is Wall Street competes. Somebody wants a 350 spread, then a 3.25, then 295, then we suddenly get back to 2, and it's like, okay, guys, normal market. But in a world where the Fed is just killing us, water torture, it's just so hard. What do you think, Jonathan?
No, I agree. And I mean, prepayment penalties are something that just a year ago, like it was unheard of, even in the 1 of 4 space, right? Like we didn't really talk about it because everyone was in the conventional FHA, VA. Those things don't have prepayment penalties. Now it's like common knowledge. I get asked all the time, "Hey, is there a prepayment penalty on this?" It's like an actual thing that gets talked about. And that's obviously a protective measure for the banks and for the investors. But really look at, and this is just another, little piece of advice. I mean, really look at what the prepayment penalty is when you're doing the loans, and, it may be worth, choosing a lender, or you're having your broker choose a lender that has a lesser prepayment penalty, an actual hit, because who cares at the end of the day? Who cares if it hurts the banks? It's about what's best for you, right?
Absolutely.
So if it's 6 months of interest and that's way less, then you can take that little 6 months of interest, pay it, bite the bullet, and then refi something better. So don't let it stop you from taking advantage of the opportunity, but at the same time, be wary of what's going on with the markets.
Yeah, and again, I think one of the things that will happen, right? We get to a terminal rate and we pause all of 2023, is the capital markets are still flush. And really what it is we will see the competitive cycle kick in. And that just means that spread, or whatever you guys call it, they'll just compete to lower it. It's just how the order works, right? Right now, they're just all, blowing out their spreads. They're like 2 standard deviations, even 3 standard deviations more than normal. That won't last. It will reset to the median. Don't you think, Dustin?
Yeah, it has to. It's just not a, like we said, I think it was Bank of America maybe, or Chase, that came out a couple days ago and was like, we're going to make, I don't know what the number was.
Bank of America said that because of the Fed rate hikes, we're going to make billions of dollars simply parking money.
Like just like, it doesn't, not rocket science. We're going to put it on,
wheel the barrel over there and make some money.
It's disgusting.
Yeah. And again, that is because right now they're charging us a point, or not even a point, sorry, a 1/10 of a point. They're sticking in overnight is at 3.5 or whatever the hell it is. They're making like 36x. This isn't 10x. This is 36x. Frustrating.
Yeah.
Frustrating. So let's talk about a rate cut next year. I personally hope we don't have one, because I think a rate cut next year perpetuates the party. I think the Fed is trying to get rid of what's called the Fed put. But do you guys think we may have a rate cut? Do you think this thing gets over its skis, economy resets, and we need a Fed rate cut next year? Jonathan, what do you think?
I mean, we'll see where inflation lands, right, on the old inflationary data, because that's what they keep quoting that they're going off of, right? He wants to get back to 2%. If 5.25% or 5% or whatever the federal funds rate is gets us there, then maybe. Or if it gets so bad in the real estate world that they have to inject the money and bring it lower, then yeah. But until that, I feel like we're just going to be, like you said, limbo and staying in that playing space until things kind of calm down.
Yeah, we got to get through this. I mean, the everything bubble, or whatever people are calling about. And I don't know if you guys saw the residential numbers this morning. The median home price came down to 384,800, if memory serves. Transactions were down a little bit month on month. Not down as much as I thought, but I think that's coming because we had that little blip in rates in July, August. But yeah, I think, and inventory is down. I mean, that's just wild to think about, right? We've got all this demand destruction and inventory is down. The residential landscape is so broken because of, 80% of loans, according to Black Knight, are below 4%. So it's a wild time. What do you think, Dustin?
Yeah, I think what I've started to because we're doing a lot of purchases, obviously, right now with this market, and for mainly investors, of course. But I'm seeing a gap between sellers that are, let's say, needing to sell.
Need versus want.
Just kind of dipping their toes in the water and seeing where the market's at. And I think that's bringing down prices, or bringing the median price down a little. because in some markets, I mean, you know, we live in Southern California and do a lot of business here, but you're seeing the $1.2 million single family residence for those homeowners that are needing to sell,
Mhm.
taking a 150K haircut. You know,
Yeah.
those that's the pocket right now that I'm seeing the biggest like drop in prices is maybe your $1.2 million 3-bedroom somewhere in Southern California single family residence. Whereas those that aren't really needing to, you know, sell are just kind of throwing it out there and not really, you know, doing much other than dipping their toes in the water.
Yeah, we're gonna find out just how many flippers, how many busted Airbnbs they are, because again, I think there's a lot of people that did some flips with hard money that are going to try to rent it out till next year. Hope the spring's better. We got a lot of people that came into the Airbnb space that were really built on unrealistic expectations. We're going to see, right? The next 6 months are going to be very interesting when we get to the spring selling season. It's going to be fun to watch, but the next 6 months are going to be wild as an investor. I'm looking for people who need to sell. I have capital ready to go. But yeah, I'm not going to play with anybody who wants to sell. I'm going to find somebody who needs to sell. So we'll go to Dustin. Dustin, how should people reach out if they want to reach out to Convoy?
You know, email us at privateclient@convoyhomeloans.com. And then I do want to give a shout out to John because John revamped our entire website. And there's actually a way that you can fill out a form and you can put that you came from ORAT. So that's a little, yeah.
That's awesome. That's awesome. Dustin, Jonathan, thank you so much for doing what you do, folks. If you want to just see what if they can help you, reach out, private client at Convoy Home Loans, and let them know you came from ORAT. Thanks, guys.
Thank you.
Yep.